Hi everybody, Ken Hume for James Alexander, Property Chat. This week, Brexit. Article 50, it's triggered. What does this mean for the housing market? Stand by. Hi everybody, this week we're talking about Brexit, house prices, what may happen in the next 12 months or so. Everybody's a little bit worried. Nobody really knows what Brexit means in its entirety. The next 2 years of negotiation will hopefully shed some more light on that. In the meantime, what will happen to the property market? Well, let me tell you about what's happened so far, and then we'll look at some historic trends to see what that means as well. First thing so far, as soon as Brexit was announced last year, we found that there was a fall off in prices, and that fall was about 5% here in the suburbs of Greater London. And we found since then that they've been holding up very well. What we found is that volumes are lower, transaction levels have been lower, but actually the demand has been higher than the level of supply, so therefore prices have held up quite firmly. So whilst we've seen the fall off by about 5%, it's held very firmly since. What does Brexit mean for the future now Article 50 is triggered and we're definitely going through with it? Well, a couple of things. First of all, if you've been following the housing market, and especially if you've been following landlords, you'll realise that the government have been meddling severely when it comes to landlords with stamp duty on Section 24 taxes and the like. Now they're going to be so tied up with the Brexit administration that I don't think they're going to have much time to meddle with the housing market in terms of further taxes and further punitive measures to try and restrict and hold back or take the heat out of the market while they're dealing with the Brexit negotiations and all the administration that will go with that. So that's a positive thing for the housing market. What we tend to experience is that when there's no meddling by governments, the free market will prevail, and the free market historically has been very good in the UK. Let's look at some of the trends over the years. So if we go back in history, going right back from 1952 here and coming up to 88, you'll see the trend has been upwards, a slow upward curve, but very definitely upward, huge rises over time. And then in 88, well, that was the peak of the market back then. About 1990, there was a crash. And the reason the crash was there were a couple of combining factors. Again, government meddling was one of the things. What happened was that we had a thing called double MIRAS relief, and that meant that for a couple you could get tax relief on your mortgage if the two of you banded together to buy a property. So what it meant was if there was a couple buying, it was significantly cheaper to buy prior to the MIRAS deadline. So we all piled in, and in piling in, prices were driven quite heavily, and after that everything went a bit quiet. Why? ERM, the exchange rate mechanism. What happened was that we entered the exchange rate mechanism. Good old Nigel Lawson, what he did was he put up interest rates in order to try and hold the value of the pound up, and the markets were betting that the pound would fall anyway. And eventually we pulled out of the ERM because interest rates at one point hit as much as, with the banks, 15%, can you believe? And that was just crazy times, and a lot of people lost their homes, so it was quite a sad time as well. But just to look at the trend on that, you can see that yes, house prices went down, but actually if you look over time, it was a relatively short period of time before we saw a substantial climb. You know, going through all of the Thatcher years, we then had, you know, lots of right to buy going on, and then a huge market jump. And then of course we had buy-to-let mortgages for the first time, and the buy-to-let mortgages led to a huge rise in interest in investment in UK property from individuals rather than just traditional landlords. And so we can see that it really did spike, an exponential up curve there. Look, I mean, gosh, between 2000 and 2006. Then what was happening by 2006, the building societies and banks had cottoned on that they could get these loans that they were giving to people and sell them onto the market at a premium, so that instead of having to make a profit over a 25-year loan, hope that your borrower was satisfactory over that time, you could actually sell these mortgages into the market, make a vast profit quite quickly, and then get somebody else signed up with that same money that you've just sold plus profit. And what this led to was people like normal banks normal building societies converting to banks in order to be able to carry out this procedure. And Northern Rock was a classic case of offering very high loan to values. At one stage offering 125% mortgages, can you believe? 125% of the value. And the criterion in order to obtain these mortgages was very loose. You know, I mean, virtually if you could breathe, you could get a mortgage. It was incredible. So by being so slack in the way that they checked people's history, what they found is that people started to default on loans en masse. And so the building societies and banks started to realise that there was going to be a run on this. America followed, as you know, and then before we know it, we're in a situation where loans were very, very hard to get. Banks were very reticent to lend at all, let alone at the sort of percentage we've seen before. It led to a thing called the Mortgage Market Review, which took a long time to come through, but nonetheless, we did see a dip. But let's look again at the time frame, 2006 to 2009. Yes, substantial dip. But let's face it, if you're in property, you're probably in it for 25 years or certainly in excess of 5 years. And if we look through history, we'll find that always, over a 5-year period or more, the housing market has only gone one way, and that is up. So yes, in terms of what's happened in the past, there have been recessions. And yes, this time we have seen a slight dip in 2016. But what does it mean for the future? Well, what we think will happen now is, on a lack of supply, prices will hold steady. Many vendors will choose not to sell on the back of not understanding the full implications of Brexit. And the truth is, I don't think many people, including the economists, really understand the full implications of Brexit. But what it really means to us is, where's the market going to be and what's going to happen? We think it's about supply and demand and an underlying need in London to get to accommodation. And as far as London is concerned, some of the outlying areas may be a bit different, but there does seem to be an ongoing large degree of demand that can't be quenched by the level of supply we currently have. And we don't see that supply changing anytime soon, as vendors do what us Brits are very good at when we're not sure what's going on in the market, and that is sit and wait. And there will always be those purchasers that need to get to the area for work and the likes, or that just want to invest. And as the market goes up and runs away from people, then things can get quite tricky. So our advice: Brexit is already discounted. The market will continue regardless. And actually, when the market's dipped slightly, history tells us that longer term the trend is upwards. So I would suggest that in the scheme of things, just to put things into perspective, your money's safe in UK housing. No need to panic sell now. Our advice is hang on in there if you're a landlord. We think that in the future there will be less availability of rental property due to the punitive measures the government brought in. We also think that longer term the future's bright for property, because guess what? We're still not building enough, and demand here in London is huge. That's it for this week. Thanks for watching. Hope you enjoyed it. Please share and like the video, and please do post your comments. We're interested to hear what you've got to say. Take care.